We recently had our first progressive capital niche alternative conference in Zurich, where we had experts from 3 niche alternative areas, namely from shipping, music royalties and litigation financing. We believe that all of these 3 investment themes are ways to achieve the original purpose of alternative investing, which is to achieve superior returns and to add complementary correlation benefits to an existing portfolio. Since the great financial crisis in 2008, central banks have flooded the financial system with various QE programs. The effect is most visible in the fixed income market, where 12 trillion currently are invested at negative yields, but it's also visible in the equity markets, where most markets trade at highs, and it can also be seen in the private equity market, where many deals close at peak multiples. From our white paper, you might know that we believe for achieving superior returns, it's more critical to do the right thing than doing things right. And by that we mean looking for an investment universe where competition is lower and where there is less capital chasing the deals.
So obviously it's a very competitive situation to put money to work, and especially on liquid investments. Yields or expected returns have dropped dramatically. We think that we are close to the last part of the bull run, and so we like low correlated investments, and we like investments which are pre-institutional and therefore have a better risk-reward ratio.
Music royalties and litigation financing belong in our definition to pre-institutional assets. Shipping is a temporary abandoned investment theme. All 3 have in common that the current risk premium priced in these assets is too high relative to what we believe the risk is.
Given that we buy at an extremely low price level, and after a prolonged downturn in these asset classes, we think the upside versus the downside is extremely attractive. So when we can buy ships at the price level where we get around a 10% yield on unlevered investments, we consider this extremely attractive. We might be half a year or a year too early, but generally we buy cheap, and that means that the risk reward becomes skewed to our side.
Litigation financing, shipping and music royalties are, in our opinion, very attractive propositions in a less crowded market. That said, these 3 opportunities do not make a portfolio. In our opinion, a balanced portfolio should hold between 15 and 25 different niche alternative propositions. Success in niche alternatives is based on experience and expertise in the field, as well as on a wide network of industry contacts that allow to have a constant, attractive deal flow.
We need to diversify the different cycle of the different asset classes or the different niches we can access. And we are aware that if we go into pre-institutional asset classes, once they become institutional, their returns will drop. So we always have to be looking for the new and interesting space we find out there. And then the second part, the temporarily abandoned asset classes, are obviously where we play the cycles, where we buy, let's say, something for 60 cents, which is worth $1, and we play this discount and this low valuation, and then we have a time frame of 2 to 5 years to realize fair value. And the combination of these 2 investment topics makes an attractive portfolio.